Hello, greetings. Welcome to the introductory problem for Appendix E. Appendix E, remember, is at the back of the textbook. If you haven't read the appendix and you haven't listened to the video, you may not catch some of what I'm saying here. This is much more complicated than some of our earlier exercises have been. So I'll go through this exercise as an introduction to how to do the exercises, but I'm making the assumption that you've read the appendix, you've listened to the video, and that you have some background to bring to the discussion. Now, exercise 4, here we go. Appendix E, the introductory problem right there, is exercise 4. And exercise 4 is on page 771. And it says preparing financial statements for investment securities. And Media Inc. began in 2013 with $100,000 in both cash and common stock. The company engaged in the following investment transactions during 2013. So it purchased $40,000 of marketable investment securities. It earned $1,200 from cash investment revenue. It sold investment securities for $28,000 that had cost $20,000. It purchased $15,000 of additional marketable investment securities. It determined that the marketable investment securities had a fair value of $41,000 at the end of 2013. So those are the transactions, and it said, and the requirement is use a vertical statement model. So we haven't done the vertical statement model for a few weeks now, in fact several weeks. And so the vertical statement model is, here's the assets, here's the owner's equity, that's all we have in this particular transaction. Here are the events. They start with the beginning balance, and instead of writing journal entries and then posting them to T accounts to get the account balances, we're simply entering the transactions into this Excel spreadsheet, and then we will determine the balances of these accounts, and then we will use that to make up financial statements. So the financial statements then will look like this, just like they did before. So as we look at use the vertical statement model, what we have is a beginning balance. So I'm going to try to keep that where you can see it, and yet I'll probably have to move it up in a minute. Here's the beginning balance. Here's the $100,000 in cash and the $100,000 in common stock. The first entry is a purchase of securities. So cash went down by $40,000 and investment in securities went up by $40,000. The second one is there was a cash revenue. Now, whether this was cash dividend or cash interest, we don't know, but there was $1,200 in cash, with cash going up, and then retained earnings would have gone up. Of course, now you understand that this would have gone into interest revenue that would have been shown on the income statement below operations, and then it would have been, or in operations if it was trading securities, and then it would have gone through the closing entries and into retained earnings. We're sending it directly to retained earnings without pass and go, without collecting $200. So it's right here, going straight there without going through all those steps that you now know that you didn't know earlier when we were using this format. And then we sold some securities. So here's the cash coming in for the securities. I'm going to take that up. Here's the cash coming in for the securities. And here's the $20,000 going down from the investments because we don't have them anymore. And then here's the $8,000 of gain in the retained earnings. And then we purchased more securities for using $15,000 of our cash went out, and $15,000 of investments went up in our securities. Now then we're going to get totals for these balances. So you now know that we just simply summed, here's the cash, you'll be able to see it. Here, we just simply summed all the information in that column. We summed those numbers and got $74,000. Now this is an algebraic sum, so it goes up with the pluses and down with the minuses. Same thing about the investment securities here. When we wanted that total, we added and subtracted and got the total for investment securities. Common stock didn't change. I know we're, and in retained earnings, I'm going to bring those up a bit. Retained earnings had 12,000 and 8,000 and got 9,200. So that's the result of that transaction. So now, through those transactions, these are the account totals right here. These are the account totals of what we have. Now then, number 5 says, determine the investment securities that had a fair market value of $41,000 at the end of 2013. So they had a fair market value of $41,000 and they have a book value of $35,000. So there's a $6,000 gain because they've gone up in value according to what the Wall Street Journal is telling us, or what the New York Stock Exchange is telling us, or whatever source we're using to find out the values of these stocks. We're looking at them as a portfolio, all the stocks together. They went up to 41. They have a historical cost of 35. So now we have a $6,000 gain. What I liked about this exercise is we do some what ifs. So let's look at number 5. And number 5 here, if it's held to maturity, we don't recognize any of that 6,000 because held to maturity doesn't get to recognize any unrealized gains due to market value changes, because by definition we're holding these to maturity. We're not trying to use these to earn, increase our cash position. So there is no journal entry recognizing the unrealized gain if they're held to maturity. The second number 5 example we have here is, what if they are trading securities? What if we're just holding these as trading securities, trying to keep our checking account working for us every day, every month, that sort of thing? Well, now the $6,000 is increased in the investment account. It can go up by the $6,000, and retained earnings can go up by the $6,000, and that's a holding gain shown as non-operating income for Treasury securities, and actually has can be an operating income. You can think of it as an operating income. Now, if it is an available for sale, if that changes for an available for sale, what you see is the $6,000 still goes into the securities, but now it goes into a separate account by itself that's reported down with retained earnings, but it doesn't go directly into retained earnings as if it came from operations. It goes into a separate securities increase account, and that's way over here in this last column, and we have an unrealized gain that's identified in the contributed capital of the company, but not as part of retained earnings. Here we have it in retained earnings. So now we're going to look and see how these numbers come into financial statements. Now I'm going to come back up here. These are assets, so we would expect to find this cash balance and that income, investment security balance. In fact, we would expect to find 41 in the investment securities in the assets. For the common stock, we have 100,000 for the retained earnings, we're going to either have 9,200 or we're going to have 15,200, depending upon which of these. If it's the treasury, we'll expect it to be 15,000. If it's the available for sale, we'll expect it to have 92 in retained earnings and 6 in this unrealized gain. So let's go down here and look and see what we found. So here's the income statement. Financial statements for 2013. They're classified as held to maturity, trading securities, and available for sale. And in the revenue, the investment revenue right there, we have 1,200 for all of them. In the realized gain, they all get the $8,000 of the realized gain because you sold those stocks in a market transaction, and you had that income in a market transaction. Now, in the unrealized gains and losses, is for the trading securities only, and then the available for sale and the held to maturity. The held to maturity, there's not going to be anything. The available for sale is going to appear someplace else than in the unrealized gain for net income in the income statement. Remember, we're working here with the income statement. So the trading securities, where you're just investing your own cash account every night to keep the earning as much money as possible, that's the one that's going to go into the income statement. This one's going to be the available for sale. It's going to be over in the balance sheet. Now here's the balance sheet accounts, and I can't keep them there, but the cash is the same for everybody. On the held to maturity, nothing happens there, so it's just 35,000. On both of these, they show the unrealized gain of the 6,000 in both trading securities and available for sale, so both of those went up. Notice how under those circumstances the total assets are not the same. Under these two assumptions for trade securities and available for sale, the assets are the same, but they're not the same as if you're holding them to maturity. Now here's the capital stock, and the company is the same. Then retained earnings is the same on held to maturity and available for sale, but the trading securities, the operating income got the gain. Now here we have the cash flow statement, and under the held to maturity, none of these transactions are showing for operating cash because we didn't have any operating activities. We have some investing activities, and we had an inflow of 28 and an outflow of 55,000 each, and that's the same. And then for the, as I'm looking down this column, the net amount of cash is the same, the ending balance is the same, and the net change in cash is the same, because these adjusting entries that we're focusing on for this chapter are all unrealized gains and losses. The realized gains and losses were the same under all conditions. So now here's the trading securities, and everything is in the operating activities, and here's the available for sale, and they're in the investing activities. So the cash flows for these two are in the investing activities. The cash flows for the trade securities are in the operating activities. So those are our statements, and that's what they look like. So here's the cash flow statement again. Here's the balance sheet, and here's the income statement. And you can see that with these three types of securities that we have, they're each different, and we would record each of them according to generally accepted accounting practices, principles and practices. I hope that it helps to see this introductory problem, and again, I welcome any comments, any questions, anything that you would like to ask. Until the next time, it's been nice working with you.